Analysts are now looking ahead to the next quarter's GDP numbers, and some remain negative in that outlook. Economist at FNB Koketso Mano joins us now to expand on this and other matters, including the fuel price. Thank you so much for your time, Koketso. Of course, we are looking ahead now to the fourth quarter of economic growth in South Africa. Do you agree with most analysts that the risk remains load shedding and this positive picture that we are seeing currently may not reflect once again?
Yeah, thanks, Dumisang. Definitely, looking at the fourth quarter, we are concerned about some of the headwinds that are probably going to come through in those numbers. We are still struggling with intensified load shedding, currently sitting at stage 4 later on today. We're also sitting with, logistical constraints continuing. In the fourth quarter, we also had, restrictions to the movement of some livestock, as we had seen, with the foot and mouth disease during that quarter. And also, we know that agribusiness confidence is also dipped. So that's likely going to reflect in the fourth quarter numbers. And also, most importantly, interest rates have continued to increase. The cost of living remains high. So from a consumer perspective, we already started to see a pinch in the third quarter numbers. And that is likely to continue going into the fourth quarter. And in general, when you look at export demand or demand from a global perspective, the current moderation in economic activity globally is likely going to affect South Africa.
Koketso, we've seen the likes of manufacturing, agriculture, transport and communication services contributing positively to the third quarter GDP numbers. But with load shedding at its highest in the third quarter in South Africa, many are asking how is it possible, particularly in the likes of manufacturing, that we are seeing these marginal improvements?
Sure. That's one way to think about it, that, despite the fact that we had intensified load shedding, we still saw productivity or activity, reflecting growth in the third quarter. But the other way to think about it is how much growth could we have had had it not been for logistical constraints, had it not been for electricity supply constraints. So all of those things, it depends on how you think about it, whether you choose to see the glass half empty or half full. But I think that growth could have been even better in the third quarter had it not been for these constraints. So that's another way of thinking about it.
I like that thinking, but how does then South Africa think differently to expand and capitalize on the current growth so that we do not see a sharp decrease?
Sure. Here is probably a difficult answer, simply because, some of the things that we really need to get to grapples with are longer term. And we've spoken to this before. These include the continued traction in structural reform, ensuring that, Transnet is up and running. And then just to mention that in the fourth quarter, we might also see the impact of that Transnet strike coming through. So we need to see, these structural, reforms coming through to support growth in the longer term. Fortunately, we are expecting that private sector investment growth will continue to be relatively robust going into the forecast period, supported by, businesses and households moving towards, improving the self-embedded or self-generation capacity when it comes to electricity. And that investment should support growth in the future. We also think that private sector investment in general will support employment growth as well in the future. So these are some of the things that we need to capitalize on going into the forecast period that will support growth. And it's important to also remember that growth of around 2% is not enough to really lift the economy out of this low growth environment and also reduce unemployment in a meaningful manner. We need growth of at least 3%. Some estimates are as high as 5%, as noted in the NDP as well. So these are some of the things that we really need to get to grapples with in the forecast period.
Let's talk about the December fuel price adjustment. It kicked in at midnight, and good news for some, bad news for others. Diesel going down for the first time in a couple of months, but petrol going up. But what's the outlook there? Because you are predicting with the rand exchange rate as well as improved international oil developments that we are likely to see decreases come the new year.
Yeah, I mean, as we said, the over-recovery on petrol is around, is over 1 rand per litre. The over-recovery on diesel is sitting at over 3 rands per litre. So the developments so far are looking good. We've seen a stabilization in the rand following some local political events. However, we are expecting the Federal Reserve to hike by another 50 basis points at the December meeting coming through in the middle of the month. And that should, weigh on the rand somewhat, maybe supporting the dollar, but also fortunately weighing on oil prices, as you may have seen this morning, sitting below $80, supported by the fact that we are going into a global moderation going into 2023, and that should have implications for oil prices and oil demand. We also did see on Sunday that the OPEC Plus group chose not to change their policy on oil production cuts, and as a result, they didn't take more measures to support prices. I think they're waiting to see the impact of the current oil price cap on Russian oil that was implemented by the EU and G7, currently sitting at $60, but also having an adjustment mechanism of around or below 5% of the market price. So all of these things are still playing through, creating some volatility, creating some risk, but fortunately it seems like a good start to the month, and we're likely going to see a cut in January if things continue in the manner that they have.
Lastly, how sustainable, though, are we expecting Brent crude as an international oil measure to stay at the current activity that we are seeing? Because anything could change from OPEC Plus countries changing their minds or meeting once again.
Sure, I mean, those will continuously create some volatility. We're also seeing an intensification of geopolitical tensions. So the volatility is still there, unfortunately, going into 2023. But as I said, I mean, currently sitting below $80 per barrel. So that is a positive development. I mean, that's the lowest that it has been since before the Russia-Ukraine conflict. But I mean, volatility is on the menu going into 2023. We are dealing with a global slowdown. But in general, I think that global slowdown will result in lower oil prices, or at least prices that don't exceed what we have seen this year. But over the forecast period, we have to remember that the supply of oil or production capacity of oil remains constrained, given, the past period where we have not been investing in much capacity, given that we're trying to move towards renewable energy. So that is still going to be a feature in the forecast period. We, on our side, expect oil prices to stabilize going into 2023, so moving relatively sideways. But the rand is likely going to be supported by slowing interest rate hikes going into 2023 from the Fed, maybe reaching or moving towards a peak in those interest rates, and also maybe potentially lower risk sentiments towards emerging markets are going to be supportive of the rand. And hopefully that comes through, and we'd see from that aspect of the fuel price pulling down on prices going into 2023.
Thank you, as always, for your insights. We leave it there with FNB Economist Koketso Mano talking to us about the forecast when it comes to fuel price adjustments, as well as the latest in South African economic growth.